Good morning, everybody, and thank you for joining us for the Crop Insurance 101 webinar. I want to give a big welcome to all of our CFLCA members, but I see that we have several names here that we are not as familiar with, so I want to welcome all of you as well. My name is Nigel Bocanegra, and I'm the Executive Director for the California Farm Labor Contractor Association. We're a nonprofit that advocates on behalf of farm labor contractors and shares resources like postings binders and training programs. Before we get started, I'd like to give a huge thank you to all of our CFLCA sponsors for supporting not just this webinar, but all of our programs. Their support makes it possible to bring this education to you. So thank you to the Zenith, DLL Insurance, Relation Insurance, Moss H2A, CISO, Bravo Ag Group, McCaig-Rosasco, DataTech, and TransferMex. Today's webinar will be recorded and we'll share the slides at the conclusion of today's session. We'll also have Q&A at the end of today's presentation, so please submit your questions in the Q&A box at the bottom of your screen. I'm now going to hand things over to today's speaker, Kristine Fox. Kristine is the Vice President with Pan American Insurance and the Director of Crop Insurance for their agency. With over 10 years of crop insurance experience, she has earned the Agribusiness and Farming Insurance Specialist designation and is dedicated to understanding the specialty crops grown in California, Oregon, and Washington. Kristine, take it away.
All right, thank you so much. I'm going to pull up my PowerPoint here, so just give me a moment to get you guys on board with what I want to discuss here. And all right, so just a quick confirmation, Nigel, thumbs up if you can see my screen. Thank you so much. Everyone, thanks for joining. I'll try to run through just the basics here of crop insurance for you. Some of the policies are pretty general, so they can kind of flow with different crop types. But I'll go over, again, just some of the general policies you can purchase, what crops they represent and how they work, and then go into some examples. A brief disclaimer, I will give you a moment to look at that, and then we will move on. But just know that what I've got here is just training material. There are, federal rules that apply to the policy. So just, make sure you're working with a crop agent who understands that. Just some brief history on how crop insurance became. Obviously we had some devastation in the 30s with the Dust Bowl. And so that kind of kicked things off with the feds coming in and trying to establish a program, some sort of disaster relief program for weather related events. And as we moved through time, some of those things were amended. In the 80s, the Federal Crop Insurance Act became available, and that was provided to help drive participation with the program. So they kind of linked the Farm Service Agency and the crop insurance program together, making it a requirement for growers to purchase some sort of minimal crop insurance policy to take part in or participate in any of those disaster relief programs that the Farm Service Agency had. And so this is just kind of the hierarchy of how the policy is driven. It's not just a standard policy that you get through, a Zenith or anything like that. It is overseen by the feds. And so the Farm Bill funds it, and then that flows over to the USDA, who regulates all the programs underneath the Farm Bill and where the funding goes. And then the Risk Management Agency, which is the RMA here on this, they establish the rules, the rates, and the pricing for the policies. And they're the ones who kind of oversee what programs become available based off of, the need or demand by the growers. And then from there, it flows down to an insurance company or a carrier, and they have a contract to do business with the feds and to follow all of their rules and their deadlines and adhere to their underwriting regulations. And they also handle the claims. So on the carrier side, they're going to be taking part if you do have a loss, you'll have an adjuster from the carrier that will come out and work with you. And then it goes over to the insurance broker, which is me. We're the ones who administer the policies, work with the growers to get your coverage level in place, inform you of the coverage options and whatnot. So a lot of people are like, why do I want crop insurance? So the most obvious is for financial security. You can't control weather. That's one of those unknowns that's out there. As you're growing your crop through the season, something could happen, multiple things could happen as we had this year. And so you just want to make sure you can continue on for that next year. And this allows you to continue, paying your bills, and gets that, maybe your ag financing. Some lenders are going to require you to get a crop insurance policy just to back up that payment. And then, a few growers are just like, hey, this is just a nice additional tax write-off for the farm. So just kind of a quick, summary of what's covered under the policy. As I mentioned, it's all weather related losses that are covered through the policy. So any adverse weather is going to be covered. And if there's an earthquake, I did have a client whose irrigation supply was busted by an earthquake, and so that was covered. And failure of irrigation or water supply due to a covered peril, which in this case would be probably drought for us here in California, that would be covered by the policy. And then you can kind of go through, insects, wildlife, all the other things that could occur. There are some policies that do cover price declines, but not all of them. So that's one of those where you'd want to work with your grower to see if that's going to be something that is covered under the policy type that you're selecting. What is not covered? So again, that adverse market conditions or price declines, it may not be covered under the policy that you select. If you're unable to secure labor to get your crop off, that would not be covered. That's not something that's weather driven or a natural peril. That's more of a man-made issue. Again, if you have improper pesticide application or anything that really doesn't relate to a weather driven event or a natural peril, it's not going to be covered under this policy. Some common acronyms that we use in crop insurance. You'll hear us say a lot of different acronyms, and we love them in crop insurance. So I'm just going to kind of go through them, and a lot of them relate to what policy types you can get. So MPCI is the most common one you'll hear. That is the policy that you can buy the crop insurance policy. It stands for multiple peril crop insurance because you're covering multiple perils. So anything that could occur naturally is covered through the policy. APH is actual production history, and that's one of the basic policy types. That policy uses the grower's actual production history, hence the name, and then we ensure your yields based off of that. It is not covering any revenue losses. There is an ARH program, which is actual revenue history. That policy would be, again, covering a grower's revenue. We do utilize a combination of yields and revenue to set the policy up, but we're looking at, more of a yield per acre, or a revenue per acre on that policy, and that would be what your threshold is driven by. And then there's policies that are more towards grain crops, and one of those would be the RP policy. It stands for revenue protection, and there's a few various little different policies that spur off of this that you can get, but that one uses a combination of a grower's yield and the commodity trade prices. So if there's a dip in commodity trade prices, there could be a payable loss just because of that. So it's kind of a combo effect on that policy. And then finally, one of the other key ones that's out there is called Whole Farm Revenue Protection, or WFRP. This is a policy that uses a grower's tax revenue to basically ensure the whole entire farming revenue operation. So if there was a decline in the overall farming operations revenue, there would be a potential payable loss under this policy. We use a maximum of 5 years of history on that. And we also look at what the grower expects to earn for the year. And so a combination of those two is utilized to establish the whole farm policy. There are coverage options out there that are different than what I'm talking about here. So I just put that in there. So livestock, dairy products, nursery, you can even insure aquaculture, but we're just going over the basics here. So when you get into your coverage, we went over a couple of the different options you can get, but within those options, they kind of all have the same general concept. A grower gets to select to insure anywhere between 50 to 85%. In some cases, it's only maxed out at 75%. So just, again, depends on the policy type that you're going to get. But it goes between 50 and 85% in your approved yield or your approved revenue for the policy. So kind of whatever policy type you're looking at, you can insure a certain percentage of that. We're looking at the same crop and the same county, so you can select coverage based off of each of those. So if you've got multiple counties that you're growing in, but the same crop type, you can select a different coverage level and option for that other county. And the same goes for different crop types. If you have almonds and pistachios, you can do them at different coverage levels. So down at the bottom, I have just a quick example of how we calculate what we call the guarantee is for the year. Guarantee is another term that we use a lot. That basically means that the policy guarantees you this amount, whether you produce it yourself or whether you need to take a claim out on your policy and it's going to cover it. So you'll see that term used on your quotes, and within your conversations with your agents, they're going to say your guarantee for the year, but that's really just your trigger point for any losses on your policy. And the way we get to that is we look at your yield or your revenue per acre. So you're going to give us your history. We're going to determine what that average is. And then we multiply that by your selected coverage level. So anywhere from 50 to 85%. And that gives you what your guaranteed yield or revenue is for that year. And it's by block type. So we can even break it down to the different blocks if you got farmland all across the area. And so an example is, 3,000 pounds per acre is what you've typically done. You want to select the 65% coverage. So you multiply it by that. And that gives you 1,950 pounds per acre guaranteed for the year. If you produced less than that amount, you are paid back up to that amount. So you're guaranteed just 1,950 overall through the policy. All coverage options have a subsidy or a discount applied, so the feds don't come in and actually pay that additional premium. But what they do is there is a base premium that's assessed, and that is the true cost of the crop insurance policy if there was no subsidy. And then they come in and say, okay, we're going to go ahead and slice that price in potentially half, just depending on the coverage level you have. And so if you look at the graph here, the top line is the coverage levels that you can select from, anywhere from 50 to 85%. The next line is the subsidy that is applied to the premium. And then the bottom line is the share that the grower has to pay. So at the 50% coverage level, a grower is only paying 33% of the actual premium that is due for that policy. And then as you go up higher, the feds decide they're going to taper off on what they apply for their subsidy. And so just keep that in mind. As you get higher in your coverage level, you tend to pay a little bit more, not only because of your liability, but because that subsidy starts to taper off on the back end. Now, each coverage option for these, what we call buy-up coverages, does have a $30 administrative fee per crop per county. And so what you're looking at here is all coverage that we would say is a buy-up option, but there is another coverage option available for some coverage, for some policy types and some crop types. And that is called the catastrophic coverage level. And so the CAT option, it can be purchased instead of and not in conjunction with those buy-up options. And it's not available for any revenue types of policies. It insures or guarantees you 50% of your average yield, and it only pays 55% of the price per dollar. So it's a lower payment option. And again, I have it in there twice, not available for revenue policies. It's only for production loss policies. I guess the benefit of this is that doesn't consider your acres, your crop type, or anything like that. It's a flat fee that you pay each year of $655 to get this policy. And you get, again, 50% of your yield insured at 55% of the price that's established for that crop. So how do we establish what your actual yield is or your revenue? This is just a quick snapshot of typical policies, what we call production history. And so this probably looks like Chinese to some people. If you're familiar with crop insurance, you may have seen this on the yearly, but we come through each year and update this with our growers. Here you can see it says the production history goes back as far as 10 years on each unit, and it just depends on how much history we have. And so this grower has 3 units that we represent here. And so some have, maybe only 5 years or 2 years. But that's how we generate the average on the policy is we get all of your production history and then there's an average. Now, you might wonder, okay, what if I had a bad year? You can see here, there's some red. That means that there were claims. So this is just kind of a closer dive into that. So for 2020 and 2019, this grower had a loss. 2019 was not as severe. They had some production, but it was just, they were paid a claim on this policy. So it's highlighted in red. But for 2020, you can see we had a big smoke event here in California. And so a lot of wine grape growers were impacted. This grower wasn't able to harvest or sell his crop. So he has a goose egg, a complete zero on his policy. And you're like, oh, that's going to drive the yield down. Well, if you see here, there's this YA yield column, and that's what the county's yield would be for, it's a county overlay for the yield if you have a loss. So if you have a 0 and you're below this 2.0, what's listed here in the YA yield, you're going to get the 2.0 instead of your 0, and that's going to get pulled into your average. And this is just to help growers when they do have a catastrophic loss event. It keeps their yield up a little bit higher. There's also some, yield floors we can apply so that if there is a dramatic dip in your average yield, there's things that we can do in the policy to help bring that back up. So here you can see an example of the average yield was 2.8, but because we're getting this 2 pulled in instead of the 0, we're going to use an approved yield of 3.0. So he's getting a little bit better yield with that YA option on there. All premiums are assessed kind of slightly differently. It's based off the policy type. So you can have a revenue type or a production type of policy or a combination of the two. It's also based off of your crop and practice. So there can be wheat that's non-irrigated and then there's wheat that is irrigated, and those would be rated differently. Also organic or certified organic or versus a conventional grower, sometimes those can be rated slightly differently. The county that you're growing in is also going to come into play. What is your approved yield? And are we including any of those options like the YA? There's a small surcharge to use that. So that comes into play with the premium. And then what coverage level are you picking? Again, you see that you have a subsidy applied. And so kind of where does that fall as far as your selection and what your premium is going to be? And then each year we have an insurance price. That's established by the USDA. So, pistachios is $2.10 for the year 2023. That comes through the USDA. They set the price, and then that's what's used on the policy. The insurance price is typically what they'll say the cost of the nut or the crop pre-harvest. So it's what it is out there before you actually went in and incurred the harvest cost. And then some policies do have an option for a grower to supply their contract price, and then they can substitute that in over the insurance price. There's some caps and some rules that apply with that as well. And it's not available for every crop type, and you cannot use it for the catastrophic level, but there is options out there. Mostly like wine grape growers will use that for their policy. So I'm just going to kind of go through a quick example of how we set up a policy. And again, going back into grapes here. So this grower is in Sonoma County. They've got Chardonnay grapes. They've got 80 acres. They provide their 10-year history to us. And reviewing everything, we come up with 5 tons per acre as their average. They get the option to use their contract price because they're a wine grape grower. So in this case, they're going to go ahead and select to use their contract price instead of the insurance price on the policy. For this scenario, the grower is going to purchase the 75% buy-up coverage level. And so you'll see that we take the 5 tons per acre times the 75% coverage level, and that gives this grower a 3.75 ton per acre guarantee for their policy. Anything they produce under that is going to be paid back to them. So just to get the total, we're going to go ahead and take that 3.75 times their 80 acres that they have. And so overall, they have 300 tons of Chardonnay guaranteed for the year, whether they produce it or whether the policy has to cover them for that. Just a quick look at the premium on this. The base premium was almost $30,000 on this. But again, given the subsidy that's applied at the 75% level, this grower is only going to pay $13,000 for the policy. All premiums for crop insurance are billed and due in September the following year. So you'll be signing up in the winter time to get your coverage, but you're not going to pay any kind of premium until September. And you can file claims all through that season, that growing season, if you need to, but you won't see a bill until September unless you're a raisin grower. They get billed in the spring. And so that's just kind of the general setup of the policy. Now let's go through a quick claim. So an unexpected weather event occurs. The grower is going to contact their agent, me, or whoever you're working with to let them know, hey, there was a hailstorm, there was a freeze, whatever happened. I just want to get a notice that there might be some damage to my crop out there. We would love for growers to call us as soon as possible. So we always put 72 hours. That's what the policy states. But we have a lot of growers that harvest their crop and then they call us, and that's okay. But there are some rules that apply with that. So just try to get the claim notice in as soon as possible to your agent if you're working with somebody, so that you can, just be at peace of mind, know that it's in. So then at that point, an adjuster is going to go out, connect with the grower, do an inspection, work with the grower through the season, and from there, the grower is going to go out and harvest their crop. In this case, we're using the scenario from before. It's a Chardonnay grower. They only harvest 200 tons and get that to market. So in this claim example, they had 300 tons guaranteed to them. They only were able to harvest 200 tons off their field. So they have a 100-ton deficiency. They selected to use their contract price of $2,500 per ton. And so in this grower's case, they're going to get $250,000 paid to them because of their loss in their yield. I just have another quick example to show that this can work for any kind of crop. And so this is a quick pistachio claim example using kind of the same concept. The grower was coming into the policy maybe with 300,000 pounds guaranteed to them over their field. They were only able to produce 100,000 pounds for the year. So they have a pretty dramatic 200,000 pound deficiency. The price again for pistachios is $2.10 per pound. And so this grower is getting $420,000 through their crop insurance policy for this loss. So the policy does state again that you need to file your claim within 72 hours of damage actually occurring or being discovered out there. You can file multiple claims through the year. That's not an issue. It is your responsibility to contact your agent. We can't, a lot of us will still reach out if we know there's a massive event in an area. We'll try to connect with our growers just to see if there's been damage, but it really is the grower's responsibility to say, hey, I've got something going on. And then at the maximum, again, if you went out and you harvested your crop, you thought everything was good, but then you got your final production and you're like, whoa, what the heck? You have no later than 60 days after that last date of harvest. And it's by crop type and by county. So, again, just keep in mind, there's a time that starts ticking once you've harvested that you cannot turn in a claim on day 61. It's against the federal rules and the insurance carrier will deny it. So we would love to do it for you, but that's where I say, better safe than sorry. And the key is that there's absolutely no penalties for filing a claim on crop insurance. It's not like your workers' comp or your auto policy where you get in a car accident or you have something occur, and then the next year your rates are going up because of that. Crop insurance is not like that. We don't increase rates by policy holder. It's based off of your yields, the county, all of those things that we dictated earlier. So you will never see an increase in your premium just for a single claim or a couple of claims. It's important that you contact a licensed crop insurance agent. There are a lot of brokers out there that sell insurance, but not all of them are licensed to sell crop insurance. You do have to take some specialty classes to do that. So just keep that in mind. And then just here's a quick snapshot of some upcoming deadlines for some crops that are out there. Again, we've got a lot of crops in California, so this may not capture all of them, but there's a few key ones here that you can, reference back to, and then obviously reach out if you have any questions about other crops. And then the deadlines that are on here, what that represents is that's the deadline that you have to have your application signed and your coverage level selected for that crop type. So you've got to have all of your paperwork in by that date in order to secure your coverage for that next year. For citrus and avocados, we're actually working 2 years ahead because the 2023 crop is already out there growing. So we'll be insuring the 24 crop for those ones. And that opens it up to any questions. So I'll have Nigel let me know if there was anything that popped up in the questions and comments section.
Thanks, Kristine. At the moment, we don't have any questions that have been submitted.
Okay.
Again, if you have any questions, please use the Q&A box at the bottom of your screen here. We'll give folks a moment to be able to send in any questions.
Hopefully I didn't blow through it too fast, but just the basics.
All right, I'm not seeing any questions popping up here just yet. Kristine, I think that I have one question for you.
Okay.
Where do you tend to see farm labor contractors running into issues most often when it comes to navigating crop insurance? Where do you think that you tend to at least come across folks who are having any sort of problems?
Obviously there's labor concerns sometimes with certain crop types, and we just have to explain that that's not going to be something that would be covered. Typically, I think, I'm trying to think with my FLCs, what I've heard. Mostly it's just the typical claims that I have. I don't have anything that's maybe production records, making sure that Because when there is a claim, you have to provide your records to the adjuster, and just making sure that the name of the policy matches the records. So if you're leasing that property out, just make sure that all has been worked out. Usually we can make some corrections, but it's not always as forgiving with crop insurance. So I think that would probably be the only thing that I would think has maybe come up, that we had to make some quick amendments or whatever, but nothing too serious.
Great. Thanks, Kristine. And of course, I'm sure we still don't have any questions, but if anybody does have any, I'm sure they are welcome to reach out to you. You have your contact information right here.
Certainly.
Perfect. Well, thank you again, Kristine, for joining us and sharing your knowledge. And thank you to everybody for joining us today as well. Again, you will receive a follow-up email with all of the slides that will include Kristine's information, as well as a link to review the webinar recording later this week. So take care. Thank you for joining us, and we hope to see you again soon. Have a great day.